Is the US Federal Reserve changing its tune on rates? Well, Fed Chair Jerome Powell said that authorities are becoming more cautious about the risks to the labor market from high borrowing prices. He, however, added that the central bank was looking for additional indications that inflation is indeed slowing down. Now, after months of higher for longer rates rhetoric, Powell's tone suggests a clear desire to cut rates. While the Fed chief was cautious not to offer any timeline for rate cuts in his Congress address, he highlighted growing indications of a cooling job market. Investors are now predicting that they will start in September after data showed a third consecutive month of rising unemployment to rein in inflation. The US Central Bank has kept its benchmark interest rate at a level not seen in almost 20 years. The bank is considering lowering rates despite the labor market's resilience so far. Fed officials are under increasing pressure to start easing policy due to a slowing in jobs data. The Fed chair emphasized that cutting rates too soon or too much could stall or reverse progress on inflation. Price pressures have eased from a peak of 7.1% in June 2022 to 2.6% as of May. Following an unexpected price spike at the beginning of the year, the Fed has welcomed new data showing inflation is decelerating again. Several officials say they need greater certainty that the trend will persist before lowering borrowing costs.
We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy.